Welcome to Iron Financial. This is the place where we cut through all the market noise to help you forge a stronger portfolio. I'm your lead analyst. Today, we are putting a true giant of the auto parts world, Magna International, right under the microscope. Their latest earnings report just dropped, and honestly, the market is completely torn. You've got headlines out there screaming about a massive beat, while at the exact same time, others are pointing to a really shocking net loss. So our mission today, it's simple. We are conducting a full structural stress test. We are going to inspect its foundation, we're going to search for any cracks in the walls, and we will determine once and for all if Magna is an iron fortress worth your capital or if it's just a house of cards ready to collapse. Whoa, hold on a second. Before you even start building that big bull case, we have to talk about the elephant in the room, the paradox that is staring all of us right in the face. This is the whole reason for the confusion. So over on the left, you've got the beat. I mean, these are the numbers that have the bulls just celebrating. Sales, adjusted earnings, operating income, all of it just blowing right past what Wall Street was expecting. But then you look to the right and you see the loss, a reported net loss of $1 million. Now look, $1 million might sound like a rounding error for a company this huge, but you have to put it in context. Just 1 year ago, they posted a $203 million profit. So the real question, the one every single investor is asking right now, is how in the world does a company beat expectations so soundly and still somehow manage to lose money? Is this a sign of real operational strength, or is it just some clever accounting? We've got to figure out which of these headlines is telling the true story of Magna's health.
You've absolutely hit the nail on the head, and that is precisely how we're going to conduct our structural inspection today. So, we've already established the paradox. Next up, I am going to lay out the full bull case for you. We're talking about the heavy steel beams that form this company's foundation. Then, I'm going to hand it right over to you, our market skeptic, so you can take out your hammer and start searching for the cracks. After that, we'll dig in and analyze the 2026 outlook, which is really management's own blueprint for the future. And then finally, we will deliver the official Iron Financial verdict. Let's get right into it.
All right, let's kick things off with the bull case. Look, when you're analyzing an industrial powerhouse like Magna, you have to start with the core operational numbers. This is the engine room of the business. Let's just forget all the headline noise for 1 second. What the bulls are pointing to is a picture of incredible operational strength and discipline. And this is especially impressive in a really messy global auto market. The underlying, and this is the key word, adjusted numbers, they aren't confusing at all. In fact, they are strong, they are clear, and they are pointing decisively in the right direction.
The absolute cornerstone of the bull argument is adjusted earnings per share. Magna delivered $2.18. Now, to put that into some context for you, the Wall Street consensus, the number all the pros were banking on, was $1.80. This wasn't just a beat. This was a complete and total demolition. They didn't just clear the bar, they launched it into the next time zone. On a fundamental operational level, this tells you that the company is generating significantly more profit from its core business per share than anyone even thought was possible.
Now let me be clear, this wasn't some kind of fluke that was just based on a low estimate. We are seeing real, sustained momentum here. A 29% year-over-year increase in adjusted earnings per share. I mean, just think about that for a second. In an environment where major markets in both North America and Europe are seeing softer vehicle demand, and literally every company is crying about cost pressures, growing your bottom line by nearly a third is a testament to some serious execution. This isn't a company that's just treading water. No, it's surging forward, full steam ahead.
But you know what they say, earnings can be manipulated. Cash cannot. For the full year, Magna generated $1.9 billion in free cash flow. This is the absolute lifeblood of any industrial company. This is the real tangible money that's left over after all the capital expenditures and all the accounting gimmicks are stripped away. It's what they use to pay down debt, to invest in new technology, and to return directly to shareholders. Generating a nearly $2 billion cash pile in a single year, that demonstrates incredible financial discipline, and it proves they are converting their operational profits into cold, hard cash. This is the financial bedrock of a truly healthy enterprise.
So, the big question is, how did they pull it off? How did they generate that kind of cash and that kind of profit growth? Well, the answer is margin expansion. Their adjusted EBIT margin hit 7.5%. That is a full 100 basis points, and for those of you watching, that's 1 full percentage point higher than it was last year. In the notoriously tight margin auto parts business, that kind of improvement is absolutely massive. It is a crystal clear signal of intense operational excellence. It tells us they're controlling costs, they're improving factory efficiency, and they're mitigating tariff impacts. Every single dollar of sales is now working that much harder for the company and, by extension, its shareholders. This is the kind of fundamental blocking and tackling that builds durable, long-term value.
And finally, for the bull case, here is the proof of long-term stability. This is not a one-quarter wonder. This table right here shows over a decade of consistent rising dividend payments. This, my friends, is the ultimate sign of a structurally sound company. Management is so confident in their underlying ability to generate cash through all kinds of economic cycles that they commit to returning more and more and more of it to shareholders, year after year. That is the very definition of a solid foundation. But of course, no fortress is perfect. What do you say, skeptic? Do you see any cracks?
Oh, I see more than just a few cracks. That was a very, very compelling story. Strong numbers, beautiful charts. You almost make me want to just go out and hit the buy button myself. But my job is to stress test this structure. We've heard all about the iron foundation. Now it is time to take out the hammer and see what's really going on beneath the surface. Because behind all those shiny, carefully curated, adjusted numbers, there are some pretty serious issues that the bears are focused on. And these are exactly the kinds of issues that you ignore at your own peril.
Which, of course, brings us right back to the central question. If the operational performance is so strong, if the execution is so flawless, then why did the stock get such a mixed reaction from the market? I mean, why are we even having this debate in the first place? With all of that supposed strength, where's the disconnect? It's time to peel back all the layers of adjustments and look at the real-world problems that are hitting the actual, no excuses allowed bottom line.
And here it is. This is the number that throws a giant wrench into the entire bull narrative. A net loss of $1 million. This is the GAAP net income. That's the official audited number that isn't adjusted for anything. And it stands in stark contrast to a $203 million profit in the very same quarter last year. You can sit here and talk about operational excellence all day long, but at the end of that day, the company went from making over $200 million to losing money. The only question that matters now is, why?
Well, the primary culprit is right here. This quote reveals a massive charge, a $132 million settlement with Ford to cover product recall costs. Now, this is not a small thing. This is a significant quality issue that resulted in a 9-figure payout. Now, I know the bulls will call this a one-time item and they'll tell you to just ignore it, to look at the adjusted numbers instead. But a bear asks a different question. Is it really a one-off? Or is this a symptom of larger quality control issues that could just pop up again with another customer next year? This single charge is what turned a solid operating profit into a net loss. It's a huge, flashing red flag about operational risk.
And the problems, they run deeper than that. This fortress isn't uniformly strong. The performance is incredibly uneven across its different divisions. I mean, sure, seating is up an incredible 103%, and body and structures posted solid 25% growth. That's fantastic. But then you get to power and vision, where their operating profit actually declined by 29%. This is a major part of their business, a key pillar of this fortress, and right now it's leaking oil. That Ford settlement probably hit this segment the hardest, but it points to a much bigger issue. You can't rely on all parts of this company to be firing on all cylinders. There are clear and significant weak points in the armor.
And these cracks aren't just internal. There are major external pressures battering the walls. And these aren't small headwinds. We're talking about gale force winds here. GM suddenly pivots on its EV strategy and boom, that immediately impacts Magna's seating contracts. Ford retools a major plant for the Escape and that hits Magna's production lines. Key programs where Magna was building entire cars are now ending, and that's causing a 10% sales decline in their complete vehicle segment. And all of this is happening against a backdrop of generally flat or softer vehicle demand. So while you see a solid foundation, I see walls that are being battered from all sides by forces that are largely outside of their control.
You know what? Those are all valid points. The risks are absolutely real. And that Ford settlement, it stings. No question about it. But investing is a forward-looking game. The past provides context, sure, but what really matters is the blueprint for the future. And this is where the bull case gets its second wind. Management isn't hiding from these headwinds. They see them, they've acknowledged them, and their 2026 guidance shows a clear, confident plan to navigate these challenges and continue building on their strength.
Let's just look at their official 2026 forecast. This is management putting their reputation right on the line. They're projecting sales to be roughly flat to maybe slightly up, which is a realistic admission of the tough market. But here's the real story. They are guiding for adjusted EBIT margin to expand again to somewhere between 6 and 6.6%. They see adjusted earnings per share growing to a range of $6.25 to $7.25. And maybe most importantly, they expect to generate another $1.6 to $1.8 billion in free cash flow. This is not the forecast of a company that's bracing for impact. It's the plan of a company that is built for profitable growth.
And what do they plan on doing with all that projected cash? Well, they intend to buy back all 22 million shares that are remaining under their current repurchase authorization. This is one of the single most powerful signals management can send to the market. They're looking at their own stock price, they're looking at their future prospects, and they are deciding that the absolute best use of their capital is to buy their own shares. It's a massive vote of confidence, and they're essentially telling investors that they believe the stock is undervalued and the future is bright.
And right here is CEO Swami Kotaguri putting it in plain English for everybody. We remain highly confident in Magna's future and in executing our plan. Look, this isn't just some corporate jargon, it's a statement of intent. After navigating a tough year, dealing with settlements and customer program changes, leadership is telling the market that they have a firm grip on the wheel and a clear road ahead. That confidence, backed by a strong financial outlook and an aggressive buyback plan, forms the core of the forward-looking bull case.
Confidence is great, and buybacks are great. I get it. But now we have to bring it all together. We have inspected the foundation and we have examined all of the cracks. We've heard the bull case that's built on operational strength and a confident outlook, and we've heard the bear case that's centered on some very real charges and daunting market headwinds. So let's settle this. What is the final verdict? Is this an opportunity forged in iron, or is it a trap just waiting to spring?
Okay, this is it. This is where we settle it. On the left, you have the foundation, and you cannot argue with the margin expansion. A 100 basis point improvement is the mark of a well-oiled machine, and that flows directly into robust free cash flow, giving them a war chest that they can then use for aggressive shareholder returns. This is operational excellence paying off in real dollars. But you can't just ignore the other side of the ledger. The cracks are real. That $132 million settlement isn't a rounding error. It literally erased the entire quarter's profit. The uneven performance is a huge red flag. A key segment like Power and Vision declining almost 30% is a serious problem. And let's face it, they are at the mercy of their customers' strategic shifts at Ford and GM, which is a significant risk in a flat market. These are not just cosmetic issues. These are legitimate structural risks. The bottom line is all about weighing these two columns against each other. The cracks, while they are serious, they appear manageable. That settlement, for all the damage it did, is likely non-recurring at that scale. The foundation, however, the margin gains, the cash flow, that's systemic. That is the result of years of disciplined work on their cost structure. That's the engine of the company. The headwinds are temporary storms, but this engine is built to weather them.
So our final verdict is in. Despite the cracks, despite the headwinds, and despite that ugly headline loss, the underlying operational strength of this company is just undeniable. The foundation is solid, the fortress is structurally sound.
The big takeaway here is the critical importance of looking past the headline number. The market saw a net loss, and frankly, it got spooked. We did the inspection and we found an engine of operational excellence that's generating massive cash flow and expanding margins in a really tough environment. The paradox is resolved by understanding the difference between a one-time charge, however painful it might be, and a systemic, long-term improvement. The key is to identify which is which. That's how you find value where others only see risk. And that is how you forge a stronger portfolio. Thanks for joining us on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.